They called it the backbone of crypto, a stable, unshakable currency tied one-to-one to the US dollar, the glue holding the entire market together. But what if I told you that backbone was made of smoke and mirrors? In today's episode, we investigate Tether, USDT, the world's biggest stablecoin, the quiet linchpin of the crypto economy. Tether is supposed to be boring, always worth $1, yet it's anything but boring. It's the currency fueling over 2/3 of all Bitcoin trades, a mammoth $80 billion asset propping up the crypto markets. And for years, a question has haunted it. Does Tether actually have the money it claims to have in the bank? Flashback to 2021. Bitcoin is surging, and Tether's tokens are flowing through every exchange. Then, panic. Online chatter spreads like wildfire.
Tether is a lie.
They don't have the dollars.
In chat rooms and on Twitter, traders whisper about what a collapse of Tether would mean. Could this be crypto's Lehman Brothers moment? For a few nail-biting days, uncertainty reigns. Crypto prices wobble as everyone from small traders to billionaire investors holds their breath.
The oldest and largest cryptocurrency, Tether, has had to settle with both the New York Attorney General's office and the Commodity Futures Trading Commission this year, over claims that it had misled consumers about the status of its reserves. Ratings agency Fitch warned earlier this year that large amounts of commercial paper held by stablecoins such as Tether could have major consequences for the debt markets.
If Tether were to fail, it wouldn't just be a scandal. It could be an extinction-level event for crypto. I'm Richard Enlow, and this is Proof of Stake, where we uncover the biggest stories, scandals, and legends in crypto. Today, Tether USDT, the $80 billion stablecoin, and the mystery of what's really backing it. This story has it all. Enormous sums of money, secretive founders, whispers of fraud, regulatory showdowns, and the looming threat of a crypto apocalypse. Before we dive deeper, let's clarify what Tether is. In simple terms, Tether is a type of cryptocurrency known as a stablecoin, a digital token designed to maintain a stable value. Each Tether token, USDT, is pegged to the US dollar. The promise is that for every one USDT in circulation, there's $1 in real traditional currency sitting in a reserve somewhere, ready to redeem. In theory, this backing makes Tether stable in price, a safe harbor from crypto volatility. From 2014 onward, Tether marketed itself as the trustworthy bridge between crypto and cash. Traders could swap volatile bitcoins for Tethers, digital dollars, without the friction of actual banks. By 2017, Tether had become the grease in the gears of crypto trading, especially on offshore exchanges with no easy access to real dollars. In fact, by late 2021, over 70% of Bitcoin trading volume was denominated in Tether. It was the lifeblood of the crypto markets. But that lifeblood was taken on faith. For years, Tether insisted every Tether is backed one-to-one by dollars. Users were told their money was safe, fully reserved, and the crypto world largely believed it, or acted like it did. Until the cracks began to show. Rumors that Tether's reserves were incomplete or concocted have swirled for years. And if those rumors ever proved true, if Tether, the stablecoin titan, turned out to be a house of cards, the resulting implosion could make recent crypto collapses like FTX look minor in comparison. As one crypto analyst put it,
Tether is an $80+ billion trust exercise. If that trust breaks, the entire ecosystem could crash overnight.
In this episode, we'll chart the rise of Tether, how it became so important, and then probe the conspiracy allegations, the shadowy founders, the missing $850 million, the investigations by New York regulators, and the Commodity Futures Trading Commission. You'll hear from whistleblowers and skeptics who've sounded the alarm, and from experts who explain just how dangerous a Tether collapse could be. By the end, you can decide for yourself. Is Tether truly backed by the dollars it claims? Or is the crypto market tethered to a lie? Act 1. The Rise of Tether. To understand why Tether could be a ticking time bomb, we first need to understand how it was born and why everyone came to rely on it. Tether's origin story takes us back to the Wild West days of crypto, the early 2000s and 10s when Bitcoin was young and exchanges were often fly-by-night operations. It all began with an idea. What if we could create a cryptocurrency that always equals $1? In July 2014, a startup in Santa Monica announced a project called RealCoin. The name hinted at its goal, a real dollar coin for the internet age. The co-founders were an unlikely trio. Brock Pierce, a former child actor turned crypto entrepreneur, Reeve Collins, an online marketing whiz who became RealCoin CEO, and Craig Sellers, a technologist. A few months later, RealCoin rebranded to Tether. The message to the market was simple. We have tamed Bitcoin's volatility. Every Tether token will be backed 1-to-1 by actual US dollars in a bank. Trust us, this token is as good as cash. In theory, it was a game changer, and early on, Tether actually published pictures of bank statements and odd attestations to shore up confidence. But even in those early days, there were hints that not all was normal. For one, the team behind Tether wasn't composed of well-known Wall Street bankers or blue-chip fintech executives. They were crypto pioneers with questionable pasts. Take Brock Pierce. By 2014, Pierce was a prominent figure in crypto, riding high on the Bitcoin boom. But he also carried baggage. As a teenager, he had been associated with a scandalous .com-era startup that imploded amid allegations of sexual misconduct by its leader. Pierce himself denied wrongdoing and was never charged, but the association with what the press called a Hollywood sex scandal lingered. The fact that Pierce, youthful, flamboyant, and controversial, was a co-founder of a would-be stable currency raised some eyebrows. Still, he lent Tether early credibility in tech circles. Then there's Giancarlo Devasini, the man who would become Tether's chief financial architect. Devasini, often called JD by colleagues, wasn't part of Tether's public launch, but he soon emerged as a key player behind the scenes. Devasini is an Italian ex-plastic surgeon turned tech businessman, and intriguingly, long before Tether, he had a run-in with the law. In 1996, Devasini was caught selling counterfeit Microsoft software and had to pay a hefty fine. In other words, Tether's future CFO had a documented history of bending rules in business. Not your typical resume for someone entrusted with billions of dollars. And finally, the quiet power in the shadows. Jan Ludovicus van der Velde, Tether's CEO. If that name doesn't ring a bell, you're not alone. Van der Velde, often called JL, is an almost ghost-like figure. He rarely, if ever, speaks at conferences or to media. In photos, of which there are only a few, he appears as a bespectacled middle-aged man, happy to stay in the background. We know he's Dutch, and that he also runs Bitfinex, a major cryptocurrency exchange that shares owners and executives with Tether. But beyond that, van der Velde is a cipher. One journalist famously remarked that no one in the industry had ever met the guy, and that he might as well not exist in public. This secretiveness at the top would later feed countless conspiracy theories. So by 2016 to 2017, Tether's fate was entwined with Bitfinex, one of the world's largest Bitcoin exchanges. Their sister companies, both ultimately run by the same group under the umbrella of a Hong Kong-based parent, iFinex. Why does this matter? Because Bitfinex would soon find itself in trouble. Trouble that Tether would help cover up, but I'm getting ahead of the story. First, the promise of Tether seemed to be working. Crypto traders loved it. Instead of dealing with risky banks or slow wire transfers that took days, they could park value in Tether and move money between exchanges in minutes. By early 2017, Tether's total issuance was still modest, a few $100 million, but it was growing fast. Bitcoin's price was exploding that year, and every time traders wanted to take profits or move funds without exiting crypto, they turned to Tether. The demand for stablecoins was clear. Tether filled that niche aggressively, becoming the go-to stablecoin. But 2017 was also when the first red flags really started waving. For one, no reputable auditor would sign off on Tether's books. Tether had promised an audit of its reserves. Remember, it needed to show those dollars were actually in a bank, and even hired a small audit firm, Friedman LLP. Months passed and no audit report appeared. By early 2018, Tether quietly announced the audit wouldn't be completed. They parted ways with the auditor, offering a vague explanation that the auditing process was too detailed for a startup. That set off alarm bells for many. Too detailed? For a company printing its own money, an audit is the bare minimum, critics scoffed. Some of those critics were independent analysts on Twitter and Reddit. An anonymous blogger known only as BitFinX became a thorn in Tether's side. In 2017, as Tether's supply ballooned into the hundreds of millions and then low billions, BitFinX began sounding the alarm in long, painstaking blog posts. The core claim, Tether is creating tokens out of thin air without the dollars to back them to artificially prop up the price of Bitcoin. It was a bold accusation, essentially that Tether and BitFinX were engaged in a huge fraud to pump crypto markets. BitFinX combed blockchain data and found that new Tether tokens often coincided with Bitcoin price boosts. He or she wrote,
"If Tether is legitimate, they should have no problem proving the money's in the bank. So where's the proof?"
The posts gained traction among a small community of skeptics, but at that time most of the crypto world ignored these warnings. Bitcoin was in a frenzy, breaking $10,000, then $15,000. Why question the golden goose? Yet, behind the scenes, some troubling events were unfolding. Tether was struggling to keep real banking relationships afloat. In 2017, major banks grew wary of crypto companies. Bitfinex and Tether's accounts were shut down by Wells Fargo. They scrambled to find banking elsewhere, often in far-flung places. For a period in 2017, according to later investigations by the New York Attorney General, Tether had no reliable banking at all, meaning there were moments when no actual dollars were backing the tethers in circulation. That's right, the stablecoin designed to be fully backed found itself effectively unbacked for stretches of time due to banking issues. Rather than disclose this to users, Tether's operators tried to muddle through, using a patchwork of trust accounts and shady payment processors to hold funds. One of those payment processors was a Panamanian firm called Crypto Capital Corporation. If Tether is the most important company you've maybe never heard of in crypto, Crypto Capital might be the second. By 2018, Bitfinex and Tether had entrusted Crypto Capital with handling hundreds of millions of their dollars. It was a risky move. Crypto Capital wasn't a bank, had no license to hold money in a fiduciary capacity, and was run by shadowy figures. But Bitfinex felt it had little choice. So much money was sloshing in and out that they needed a workaround for their banking issues. Then came the disaster of 2018. Crypto Capital lost Bitfinex and Tether's money, a lot of money. How much? $850 million. Crypto Capital claimed the funds were seized by authorities in various countries, Poland, Portugal, as part of anti-money laundering investigations. To this day, some of those funds remain tied up or missing. For Bitfinex, this was an existential threat, nearly $1 billion in customer and corporate money gone. If word got out, users would panic and rush to withdraw whatever was left. So, what did Bitfinex's top executives, remember the same folks running Tether, do? They quietly reached into Tether's reserve pot to fill the hole. In essence, Bitfinex borrowed from Tether's dollars that were supposed to be backing the stablecoins, to pay out customers who wanted withdrawals. This happened in secret, with only a tight circle aware. To the public, Bitfinex said nothing aside from a terse statement denying everything when rumors leaked. Tether's website still claimed one-to-one backing, but now we know that was no longer true from that moment in mid-2018. This sleight of hand, robbing Peter, Tether, to pay Paul, Bitfinex customers, would later become the center of a fierce investigation by the New York Attorney General's office. But back in 2018, no one knew. Tether kept issuing new tokens, Bitfinex kept operating, and the crypto markets went on as usual. Well, aside from the brutal crypto winter crash of early 2018, which had many other causes. The point is, the seeds of the Tether conspiracy were planted. The company line was that everything was fine, but behind closed doors, a giant hole had been papered over with Tether's reserve funds. By the end of Act 1, we have a recipe for disaster. A stablecoin system built on trust with very little verification, run by a cast of characters straight out of a thriller novel, engaging in increasingly desperate measures to stay afloat. The crypto community at large remains oblivious or willfully ignorant, happily using Tether as digital dollars. But some are starting to ask hard questions, and regulators are waking up. Act 2. Cracks in the foundation. If Act 1 was the setup, Act 2 is where the facade begins to crumble, at least for those paying attention. By 2019, whispers about Tether's legitimacy had grown too loud for authorities to ignore. In April of that year, the truth started to emerge in dramatic fashion. Imagine the scene. It's April 25, 2019. Without warning, the New York Attorney General, Letitia James, issues a bombshell press release and court order that lands like a grenade in the crypto world. The headline might as well have read, "Tether was a lie." In that document, the NYAG alleges that Bitfinex and Tether engaged in a massive cover-up to hide an $850 million loss. The accusation was that when crypto capital lost those funds, Bitfinex quietly borrowed from Tether's reserves to plug the gap, exactly what we just described. And crucially, Tether's claim of being fully backed by dollars was false during that time. For Tether skeptics, this was a vindication, and a terrifying one. The biggest fear was confirmed by a top law enforcement official. The NYAG, in an official statement, put it bluntly,
Tether's claims that its virtual currency was fully backed by US dollars at all times was a lie.
Those are the words of Letitia James, the Attorney General of New York. She didn't mince words. A lie.
Bitfinex and Tether recklessly and unlawfully covered up massive financial losses to keep their scheme going. Tether's claims that its token was fully backed by US dollars at all times was a lie. These companies obscured the true risk investors faced, operated by unlicensed, unregulated individuals in the darkest corners of the financial system.
The phrasing is striking. Darkest corners of the financial system. The NYAG was painting Bitfinex and Tether as rogue operators, deliberately deceiving their users and flouting the law. It was a moment of high drama. Here you had a cornerstone of the crypto market, Tether, essentially accused of being partly a fraud. The immediate fallout? Tether and Bitfinex lawyers went into overdrive to fight the NYAG's injunction, which sought to freeze further transfers from Tether's reserves to Bitfinex. In public, they tried to reassure everyone. We respect law enforcement. We've been cooperating. This has been misconstrued. Tether admitted for the first time that yes, they had lent Bitfinex money, but spun it as a sort of arm's-length investment. They also, importantly, changed their story about the reserves. No longer did they say, every Tether is backed by a real dollar in our accounts. Instead, they updated Tether's website to say that reserves included loans to affiliate companies, like Bitfinex, and other assets. In other words, Tether quietly acknowledged it wasn't 100% cash-backed. For critics, this was the smoking gun they had been waiting for. For many crypto faithful, though, it was just a hiccup. The market wobbled only slightly at the news. Bitcoin's price dipped, but didn't crash. A lot of traders shrugged it off. Bitfinex and Tether will sort it out, they figured. And indeed, over the next 2 years, Tether did manage to keep going. In February 2021, Tether and Bitfinex reached a settlement with the New York Attorney General ending the investigation, which had gone on for roughly 22 months. They paid an $18.5 million fine, a slap on the wrist considering Tether's market size, and agreed to stop serving customers in New York State to fall outside NYAG jurisdiction. Importantly, they did not admit wrongdoing, but they had to commit to providing quarterly reports about their reserves for 2 years. Now, these quarterly reports were not full audits, but attestations by a small accounting firm in the Cayman Islands. Still, they gave a peek into Tether's reserve composition, and what a peek it was. In mid-2021, Tether revealed that only around 5% of its reserves were actual cash. The vast majority was in the form of various IOUs, short-term loans, and a large chunk in something called commercial paper. Commercial paper is basically short-term corporate debt, unsecured promissory notes companies issue. Tether claimed it held tens of billions of dollars in such paper. But here's the kicker, they wouldn't say whose commercial paper. Journalists at the Financial Times and Bloomberg scratched their heads. If Tether's disclosures were true, it was one of the largest holders of commercial paper in the world, comparable to major financial institutions. And yet, big trading desks in the traditional finance world said they had never seen Tether buying paper. It was bizarre. Was Tether lending money to unknown Chinese firms? To crypto companies? The opacity was alarming. One FT report in 2021 quoted a credit analyst saying, "It's a black box within a black box." To add to the concern, later in 2021, the Commodity Futures Trading Commission, CFTC, weighed in. The CFTC fined Tether $41 million for misleading claims about its reserves. The regulator's findings were damning. Tether had been fully backed by actual dollars only 27% of the time between 2016 and 2018, and it had lied about undergoing routine audits. They never happened. Think about that. For roughly 3/4 of the time in its early years, Tether did not have one-for-one reserves in the bank, despite claiming it did. The CFTC even noted an instance where Tether literally arranged a one-day $382 million top-up of its bank account just to pass a cursory inspection, moving Bitfinex money into the account the day of a planned verification, essentially a staged photo op for reserves. Then, presumably, the money moved back or elsewhere the next day. These revelations confirmed the skeptics' worst suspicions. Tether had played fast and loose for years. Yet, remarkably, the crypto markets kept on largely unfazed. By the end of 2021, Tether's market capitalization had grown to over $78 billion. It was bigger than ever. This speaks to a kind of cognitive dissonance in crypto. People knew Tether's operators weren't saints, but using Tether was so convenient and profitable for exchanges, arbitrageurs, etc., that nobody wanted to rock the boat. It had become the too-big-to-fail stablecoin. Still, cracks continued to appear. Let's talk about public perception and expert warnings during this period, 2019 to 2021. Some high-profile financial commentators started shouting from the rooftops that something was very wrong. One of them is Nouriel Roubini, the economist nicknamed Dr. Doom for predicting the 2008 financial crisis. Roubini is a fierce critic of crypto in general, and he zeroed in on Tether as a systemic risk. In early 2021, Roubini went on record calling Tether a ticking time bomb and a criminal enterprise. He argued that a bunch of insider whales were using Tether to manipulate crypto prices, and that it was only a matter of time before it blew up. Roubini's exact words:
Tether is a criminal enterprise, and a bunch of whales and insiders are manipulating the price of Bitcoin and other crypto day in and day out. That is a fact.
Strong words. He was essentially accusing Tether of being the linchpin of market manipulation. Tether, of course, denied this vehemently. Its spokespeople often dismissed critics like Roubini as misinformed or biased against crypto. Even some within crypto began to express unease. Hindenburg Research, a firm known for investigating financial frauds, offered a $1 million bounty in late 2021 for any insider information on Tether's reserves. Hindenburg stated plainly it had doubts about the legitimacy of Tether's backing and found the disclosures opaque. This bounty offer itself made headlines. How often do you see a bounty on a supposedly reputable $80 billion company's secret finances? Tether brushed it off as a cynical stunt, but the unusual move underscored how much mystery still surrounded Tether's operations. Regulators beyond New York also started paying more attention. In July 2021, U.S. federal prosecutors were reported to be probing Tether's executives for possible bank fraud, specifically whether Tether in its early days misled banks about the nature of its business. For example, by sending money through correspondent banks under different company names or reasons to avoid the "this is crypto money" red flag. Bloomberg broke that story, noting that the DOJ had sent target letters to Tether insiders. As of now, 2025, no criminal charges have been filed publicly, but it's widely believed that investigation is ongoing. There have also been reports as recent as 2023 of the DOJ examining Tether for potential money laundering and sanctions evasion links. Tether, for its part, claims it works closely with law enforcement and points to instances where it has frozen illicit funds at authorities' request. Meanwhile, consider the macro picture. By 2022, stablecoins had gotten so large that even institutions like the U.S. Federal Reserve and Treasury Department began warning about them. The Federal Reserve's 2022 Financial Stability Report highlighted stablecoins, with Tether being the largest, as a vulnerability, noting the lack of transparency and risk of runs. Treasury Secretary Janet Yellen in 2022 invoked the sudden collapse of a different stablecoin, Terra USD, and warned that stablecoins present the same kind of runs that you see in bank deposits in a certain way, and needed regulation. While those comments weren't about Tether specifically, Tether was the elephant in the room. Perhaps the clearest mainstream warning came from a major credit rating agency. In July 2021, Fitch Ratings issued a report cautioning that the rapid growth of stablecoins could have implications for short-term credit markets. Fitch pointed out a scenario. If a stablecoin like Tether faced a crisis of confidence and had to liquidate its assets, like commercial paper, en masse, it could disrupt the commercial paper market and even transmit shocks to the traditional financial system. In essence, a Tether run could not only hurt crypto, but also ripple outward, like if a money market fund broke the buck. This was a startling notion, that an offshore, unregulated token could pose systemic risk. So by late 2022, here's where things stood. Tether had survived legal challenges and paid fines, but its business model and opacity remained contentious. It had slightly improved its disclosures. Under pressure, it reduced its commercial paper holdings to zero by 2022 and shifted into safer US Treasury bills, which helped ease some worry. But still, no full audit of Tether's reserves has ever been released. They periodically tout assurance opinions, but those are not the same as a thorough audit. The crypto community was split. Many insisted Tether is fine. If it were a fraud, it would have collapsed by now, they argue. While others point to history and say, just because it hasn't blown up yet doesn't mean it won't. Remember Bernie Madoff went for decades. As Act 2 closes, the stage is set uncomfortably. Tether remains huge, indispensable, yet fundamentally mistrusted by those who know where to look. The cracks are visible, and yet it carries on. The proverbial bumblebee that by the laws of physics shouldn't fly, and yet does. But for how long? Act 3, the looming collapse. Now we arrive at the heart of the conspiracy concern. What if Tether collapses? What would that actually look like, and who would be hit the hardest? And importantly, why hasn't it collapsed already? Are there forces propping it up? Let's explore the endgame scenarios that keep many crypto veterans up at night. Picture a future scenario, maybe not too far off. Some piece of devastating news hits Tether. Perhaps a regulator formally accuses it of criminal conduct, or a major economic event spooks investors about stablecoins in general. Suddenly, everyone holding Tether tokens wants out at the same time, a classic run on the bank. They all start redeeming USDT for real USD. On paper, Tether says, sure, we'll honor redemptions. But imagine that wave. Tens of billions of dollars in redemption requests flooding in. Does Tether actually have tens of billions liquid and ready to pay? If any significant portion of reserves is tied up in less liquid stuff, say loans, or even things like the $1 billion+ in Bitcoin and other investments Tether has recently disclosed it holds, they might have to delay or refuse redemptions. The moment that happens, the peg breaks. USDT, always assumed to be $1, might start trading at 95 cents, 90 cents. And if panic truly set in, it could plunge further. It's not hard to see a spiral where Tether's value collapses. The immediate effect, crypto markets would convulse. Remember, a huge chunk of trading happens in USDT pairs. If USDT is crashing, exchanges might freeze those markets to stem the chaos. Liquidity for Bitcoin and others could dry up overnight because many buyers use Tether. Prices for major cryptocurrencies would likely plummet as people scramble to sell out into anything else. True dollars, other stablecoins like USDC, etc. We saw a mini version of this in May 2022 when a smaller algorithmic stablecoin, Terra USD, imploded, and even Tether briefly wobbled off its peg. Bitcoin and Ethereum dropped heavily in value in the ensuing days. Now multiply that by 100 for Tether. Some analysts have predicted that a full Tether collapse could trigger a crypto crash on the order of a 1929 stock market crash, wiping out perhaps hundreds of billions in value and trust. One Financial Times analysis in late 2022 suggested that if Tether fell, the shock could be bigger than FTX, referencing the then recent collapse of the FTX exchange. FTX's implosion was a big deal, causing perhaps $10 billion in direct losses and a broader market downturn. But Tether is an $80 billion pillar. Its fall could be an extinction-level event for many crypto businesses. An executive at a crypto fund was quoted in the FT as saying, FTX was a top exchange, but Tether is the base layer of trading. Losing it would be like the power going out for crypto.
Of the regulatory framework is in response to the actual fact of the collapse of an algorithmic stablecoin, which is different from the collateralized stablecoins that we're talking about, and the perceived risk in the future of one of these collateralized stablecoins really, sort of bad things happening to them. But at the time that we're talking, we don't have a current example of a stablecoin, Tether itself is not on a downward trajectory that is specifically worrying regulators right now.
Think of who holds Tether. Not just exchanges, but ordinary crypto users worldwide, from traders in Asia using it to move money out of restrictive economies, to DeFi protocols that treat USDT as a stable reserve, to companies that accept USDT for payments. A collapse would send shockwaves to all those corners. Now, the question, why would Tether collapse? If it's managed to survive so far, what could finally topple it? There are a few potential triggers often discussed. Regulatory or legal action, a devastating enforcement action, for instance, the US Department of Justice indicting Tether executives or seizing bank accounts, could freeze or destroy confidence in Tether. If Tether's access to its reserves were cut off by authorities, redemptions would halt. There have been whispers of investigations into Tether's banking practices and even into whether Tether has been used by bad actors, like terrorists or sanctioned nations, to move money. If evidence emerges linking Tether to outright money laundering for criminals, it would bring the hammer down. In October 2023, the Wall Street Journal reported that U.S. Justice Department officials were scrutinizing Tether for possible bank fraud, and that companies behind Tether had used falsified documents and shell companies to maintain bank access. Tether's representatives denied wrongdoing and even sued the Wall Street Journal for defamation over some claims, underscoring how high the stakes are for their reputation. Market contagion. Sometimes collapse comes not from within, but contagion from outside. If, say, a major crypto bank or another stablecoin failed and caused a crisis of confidence, investors might indiscriminately flee all stablecoins, including Tether, en masse. A flight to safety could ironically mean dumping USDT for actual USD or for a more regulated stablecoin. We saw a hint of that in 2022. After Terra's collapse, Tether faced about $10 billion of redemptions in a short period, and it met them, which was reassuring to some. But what if it had been $30 billion? $50 billion? At some threshold, the strain could break the system. Revelation of insolvency. The nightmare scenario for Tether would be if someone somehow proved that a large chunk of its reserves simply didn't exist, or were far less liquid than claimed. For instance, imagine it came out that Tether actually held a lot of questionable loans that defaulted, or that their supposed $80 billion in assets included large undisclosed losses. Now, there's a flip side to consider. Who benefits from Tether continuing to operate? Is it propped up artificially by parties with vested interests? Some believe yes. One theory is that major crypto exchanges and whales, big holders, might step in to support Tether during any momentary weakness because they need it to keep markets liquid. For example, whenever Tether's price on the open market has dipped slightly below $1, as it did briefly in 2018 and 2020 and 2022, usually arbitrage traders jump in to buy cheap USDT, which helps restore the peg. Those traders presumably trust they can redeem the USDT later for $1, making a profit. Many of those arbitrageurs are likely large, sophisticated players, possibly even affiliated with Tether. It creates an impression of market confidence. See, Tether only ever wavers for a short time and comes back to $1. But is that organic or a defense mechanism? Hard to say. Rubini's claim that a bunch of whales and insiders manipulate prices suggests some collusion to keep Tether stable. And indeed, Tether's largest clients historically included the likes of Sam Bankman-Fried's Alameda Research, which was the second largest Tether buyer distributor. If Alameda and others used Tether extensively for trades, they had a huge incentive to maintain the peg and not let Tether fail. Another group that has arguably benefited from Tether's existence are those operating in legal gray areas. For instance, criminal enterprises and sanctioned nations have been reported to use Tether to move value. A 2023 report by blockchain analytics firm TRM Labs found that Tether was the most used stablecoin in criminal activity, tied to over $19 billion in illicit transactions in 2023, even more the year prior. Why? Because Tether is widely accepted and harder to trace than going through banks. If you're a cybercriminal or a sanctioned country like North Korea trying to cash out hacked crypto, converting to Tether is a common step. Now, to be clear, that doesn't mean Tether's management condones this. They often point out how they cooperate with law enforcement and freeze funds when asked. But the fact remains, Tether's quasi-anonymous instant transfer nature makes it a favorite in the underworld. These users aren't going to publicly defend Tether, of course, but their usage adds to demand and interweaves Tether with some dangerous elements. Regulators are acutely aware of this, which is why some suspect that if Tether were ever implicated in knowingly facilitating money laundering, that could be its death knell via government action. Let's not forget the human element. Are there any insiders or whistleblowers speaking out? Tether, being so secretive, hasn't seen many insiders break ranks, but occasionally tidbits emerge. A former bank partner of Tether once anonymously told a journalist working with them was a nightmare, constant compliance issues. And in 2022, when asked about Tether's stability, Sam Bankman-Fried, before his own downfall, oddly said that if he mentioned any concern about Tether, they'll attack us on Twitter. This hinted at Tether's aggressive defense tactics. They have a history of vociferously attacking critics online, often labeling any negative news as FUD, fear, uncertainty, doubt, spread by competitors. It's an almost cartel-like mentality. Defend the brand at all costs. That culture makes it harder for potential whistleblowers to speak up. So we have a situation where a collapse could be catastrophic, yet hasn't happened. This leads to a final burning question. Is it possible that Tether is actually finally safe and fully back now? Could all this conspiracy talk be outdated, perhaps true in the past, but fixed today? Tether's current management claims it is solid. They publish breakdowns showing tens of billions in treasuries, a chunk in cash, some in secured loans, etc. They even started publishing limited financial statements, for example, claiming a profit of $1.5 billion in one quarter and that they have excess reserves. In 2023 and 2024, Tether loudly touted that they earned so much from interest on U.S. treasuries, since rates went up, that they made billions in profit, boosting their reserves further. They also announced they were eliminating their loans and increasing transparency. All of this is meant to reassure. However, skeptics remain unconvinced without a proper audit. Even with more disclosure, Tether's opacity in earlier years and its offshore structure leave a lingering cloud. An outspoken crypto fund manager, Justin Bonds, argued in late 2023 that Tether was still essentially a confidence game. He wrote,
Tether is an $80+ billion scam, bigger than FTX and Madoff combined, because it still hasn't provided the proof of reserves promised since 2015.
Bonds and others note that, incredibly, it's been 8 years and counting, and no independent auditor has been allowed to verify Tether's full balance sheet. Why not, if there's nothing to hide? Tether counters that top accounting firms won't audit any crypto company due to risk, but notably its smaller competitor USDC, by Circle, does undergo regular audits by Grant Thornton. So, that excuse rings hollow.
Let me put it this way. In 2008, a Lehman Brothers money market fund collapsed, which acted as an accelerant for the financial crisis. Could the same thing again happen with Tether? Just say I'm concerned, okay? Why should you care about Tether if you own some other cryptocurrency? Simple. Do you have any idea how much Bitcoin and Ethereum are purchased with Tether? It makes up a huge chunk of all transactions. Tether's like a $60 billion company. If Tether collapses, well, then it's going to cut the whole crypto ecosystem. So if you own crypto in any form and you've got big gains, I recommend taking something off the table.
It's a chilling thought, and it leads to a twist. What if Tether doesn't collapse spontaneously? What if it actually winds down safely one day? Is that possible? Conceivably, if regulations tighten, for example, if the US passes a strict stablecoin law, Tether might find itself cut off from the banking system or facing legal bans in major economies. In such a scenario, perhaps Tether's owners would slowly redeem and shrink the supply over time, rather than face a crash. It would be like a controlled demolition instead of an implosion. This might be the best case ending for the crypto market, to replace Tether's role with regulated alternatives before disaster strikes. Indeed, regulators often talk about wanting to transition to stablecoins that are properly supervised, maybe even central bank digital currencies eventually, to reduce systemic risk. Will Tether's story end with a bang or a whimper? As of now, Tether is still here, bigger than ever. It's almost paradoxical. The longer it survives, the more people trust it, but also the bigger the potential fallout becomes. It's as if a dam is holding back a giant lake above a town. Every year, the town grows and builds more houses below that dam, trusting it will never break. Every inspection finds cracks, but the dam holds until one day, maybe it doesn't. Thanks for listening to Proof of Stake. In crypto, as in life, trust but verify. If you enjoyed this episode, make sure to subscribe, leave a review, and tell a friend. It really helps us out. Got a crypto mystery we should cover? Let us know. We'll see you next time.